Hey guys, welcome back to another exclusive podcast from IronFX. At IronFX, we are dedicated to bringing you the absolute best trading education to help you take your trading to the next level. My name is Ketan Ramachandra, and in today's podcast, we will be talking about inflation. What is CPI and PPI, and how does it affect interest rates? As we all know, inflation has been the hottest topic over the last 18 months, right? We've seen central banks around the world, major central banks around the world, combating inflation by raising interest rates. Okay, so before we dive into what is CPI and PPI, let's just look at let's just talk about and look at inflation and interest rates from the US perspective, right? Because that's what is driving interest rates for the rest of the world. As we all know, the Federal Reserve is the largest and most powerful central bank in the world, and whenever there's a change in direction from them in terms of monetary policy, the rest of the world, meaning the rest of the central banks from from the major economies, will generally follow suit as well. Okay, so why is inflation such a hot topic? Okay, so together with this podcast, we've also included the relevant links for you guys to click on, and also to be able to visualize what we're talking about today, right? Since this is a podcast, it may be pretty difficult to visualize the history of interest rates, what is CPI. So we have included the relevant links, so please look at them. Okay, so the first link I'm going to look at is Consumer Price Index, all items US city average. Okay, so this is the main headline CPI index for the US. Okay, the chart that we are going to be looking at is on a annualized basis, so that means year over year change for inflation. Okay, so why has inflation become such a hot topic, right? Okay, we in the US, headline inflation or CPI reading hit a high of almost 9% year over year in June, right? If I'm not mistaken, yes, in June of 2022. We have not, the US and the world has not seen levels of inflation like this since 40 years ago, so in early 1982. Okay, now, during this period, inflation was actually coming down. So in the 70s, mid 70s, or actually starting from the 70s, there were three major waves of inflation. Okay, so just a quick history on inflation in the US. So inflation started rising rapidly at the end of the 1960s, right? So the first wave of inflation peaked at about 6.4% in early 1970. It came back down, and then we had the second wave of inflation rising into 1975, going as high as 12.2% year over year. It came back down again in about 1977, and then we had the third and final wave of inflation that hit 14.6% in the first quarter of 1980. And this was when finally inflation had truly peaked in the US, and they finally brought it down all the way down to 2.5% about 3 years later. So as you can see, the major inflationary period in the US stretched from about 1968 all the way to its final and third peak in 1980. So that was a stretch of 12 years before they finally brought it down to levels around 2.5 and 3% 3 years later. So it's actually more than a decade of high and low inflation, right? So this is something that the Federal Reserve would like to avoid. So hence, when interest rates started rising very quickly in 2022, or early 2020, middle of 2021, and in 2022 it accelerated. They were very determined not to repeat the mistakes of the Fed in the early 1970s. So hence they started raising interest rates very aggressively, right? Okay, so this is some historical background on inflation with respect to levels and how long it lasted in the past. And although we have just inflation does look to have peaked in June of last year and is coming down pretty steadily. Uh, we have to understand that inflation comes in waves, right? Usually, if there is a big inflationary spike, or at least in the US, it's come in waves. So in the most recent, or the period which had the most high periods of inflation was in the 1970s to 1980s. So there were three major waves of inflation, and the current Federal Reserve committee members do not wish to have a repeat of that. So they are hoping that with aggressive policies and aggressive hiking of interest rates, they're able to tame inflation within one wave. Okay, so now what is CPI and PPI? So inflation consists of, I guess generally speaking, two components. CPI, which is Consumer Price Index. So this is items that the consumer would buy, and PPI, which is Producer Price Index. Okay, so there are two major components that the Federal Reserve and its committee members track. So let's just start off with Producer Price Index first. Okay, so what is PPI? Okay, so the PPI is the Producer Price Index, which measures the average change of time in the selling prices received by domestic producers for their output. Okay, so this is the technical definition, but what does it actually mean? It is actually the inflation that is experienced by wholesalers. So that means all your producers at a wholesale level are affected by PPI prices. So that means when they buy raw commodities and goods, and then they package it and process it into the final product, and then after that they sell it to the retail market. So this is the inflation that is experienced by wholesalers. So PPI, or Producer Price Index, is also sometimes referred to as wholesale inflation. Okay, so now what is PPI made up of, right? So because it is the change in time of selling prices for products and some services. So what are the underlying components of the PPI? Okay, so the next link is from the US Bureau of Labor Statistics. We have included that in the show notes as well. Okay, so this link, when you click on it, it will show you the final demand for PPI over a 12-month percentage change period. So this means this is the year-over-year change for PPI. Okay, so in this chart here on this website, you're able to see the various components such as goods, foods, energy, services, transportation, and warehousing. Okay, so you can see all the various components that make up PPI. So PPI has peaked at about 11.7% in March of last year and has been falling pretty significantly. So at least at the wholesale level, inflation is falling quite rapidly, and that is very encouraging for the Federal Reserve. So that is at least telling them that by them raising rates, at least on the wholesale side, they've seemed to have brought inflation under control. Okay, so now we'll go back to CPI. So what is CPI? Okay, the CPI is the Consumer Price Index. It is a measure of the average change over time in prices paid by the urban consumers for a market basket of consumer goods and services. Okay, so now the next link will take you to the 12-month percentage change for CPI and all the components related to it. So as you know, the CPI is a basket of goods and services such as food, energy, electricity, um, medical care services, shelter, and education. So if you click on the various components, you're able to see how they have risen rapidly in early 2021 all the way to 2022, and CPI peaked in June at about 9% of last year, right? June last year, 9.1% headline CPI has peaked and has now fallen drastically to 5%. And also, if you look at the core, right, which is all items less food and energy, it also peaked in let's see, but September 6.6% of last year, and it's fallen and has moderated, but not as quickly as headline CPI. So now this might be a bit worrying because this is telling the Fed that although headline CPI is falling, but the core CPI is not falling as quickly as they would like. So this means that inflation could still persist, and looking at the way the economy, or looking at the current state of the US economy and labor market, we may get one more interest rate hike in May. Okay, so the Federal Reserve will convene in early May for the next meeting, where market expectations for a 25 basis point rate hike seems very likely to occur. So interest rates are currently at the level, because there's a range. The Federal Reserve keeps a range there's a band where the interest rate ranges in. So it's now currently ranging between 4.75 and 5%. So if they do raise interest rates in May, that will bring the target range from 5% to 5.25%. Okay, so the idea behind raising interest rates is to make things more expensive for wholesalers, for corporations, as well as for consumers and households. So when things become more expensive, it is expected that demand will slow down. So this means demand at the consumer level, demand at the retail level, demand at the wholesale level. So when demand starts slowing down, prices may follow suit. So this is the main objective of why interest rates were raised, in order to combat inflation. Because the Federal Reserve has doesn't have many tools to combat situations where there's high inflation, and the tools that they have are generally quite blunt. So they can raise interest rates, cut interest rates, and there's also other things, other actions that they can do, which is like reduce liquidity in the markets by offloading their balance sheet. So when we had the financial crisis in 2007, 2008, the Federal Reserve unleashed QE, or quantitative easing. This was a program to inject liquidity into the market, to stimulate credit markets, to stimulate financial markets, and to help revive the economy. And now, while interest rates were also being raised, the Fed was also embarking on QT. QT is quantitative tightening, which is the opposite of QE. So instead of buying bonds in the open market to inject liquidity into the system, they're actually now rolling off their balance sheet or selling the bonds, for example, and reducing the overall liquidity in markets. So this is the QT is the opposite of QE. So they are reducing liquidity. So when liquidity is reduced, also generally it means that, and together with higher interest rates, that means it's more expensive for corporations to borrow money to for example, further expand their businesses or increase their capital expenditure. And it's also more expensive for households to buy big ticket items such as homes and cars. So this is the two main tools that the Federal Reserve has in its toolbox to combat inflation. So one is raising interest rates, and the second one is quantitative tightening, right? Okay, so these are the two major tools that we have, and that is why this is quite important. Normally, when inflation hovers around between 2.5 and 3%, the Fed doesn't need to be very aggressive with raising interest rates. But this is the first time in almost 40 years where inflation has risen very strongly, and hence the Fed has reacted in the manner that we've seen over the past 18 months or so. Okay, so yes, so I've pretty much covered what is CPI, what is PPI, how it affects interest rates, and what are the tools that the Federal Reserve has in order to combat inflation and bring it down to a level that is more acceptable. So basically, the target inflation rate for the Federal Reserve is 2% year over year. So every year they're expecting inflation to grow at a rate of 2%, which is something that is manageable for everyone. So for consumers, for big corporations, and for households and individuals. But inflation has skyrocketed in 2021 and early 2022, and hence the Fed has reacted the way it has. All right, so okay, so I think we've covered the main things for today. All right, so I hope this has been a great listen for you guys, and also please take note, please do remember that we have included the links in the show notes so that you are able to explore the data on your own, and to help you visualize the trends as well. All right, so okay, anyway guys, that's it from me for today's podcast on CPI and PPI. Do remember to subscribe to our future podcasts here at IronFX, and also we are dedicated to bringing you the very best trading education to take your trading to the next level. Until then, stay safe and trade safe. All right, take care guys.